What if the greatest threat to your retirement isn't happening on the public stock market, but inside this shadow market that doesn't even publish its prices?
Yeah, that's the scary part, right? Because right now, the major stock indexes are just, hitting all-time highs. The consensus out there is that everything is cruising along perfectly.
All right. But our source today is looking at that exact same economy and, well, predicting a sequence of events that ends with the Federal Reserve in panic mode and gold rocketing to $10,000 an ounce.
Ah,
So, welcome to today's deep dive.
thanks. Yeah, we are unpacking a highly contrarian, just deeply fascinating macroeconomic thesis today. And our source material is a very candid, on-the-record interview with Ed Dowd.
And he's a former BlackRock money manager, right? Known for making these really bold calls.
Exactly. He spots systemic rot long before it ever makes the evening news. And the thing is, he isn't relying on wild speculation here. He is pointing to specific, observable data points and historical patterns to argue that the underlying engine of the economy is quietly stalling out.
Okay, so let's unpack this. We need to map out the causality of his argument today, tracing how a hidden freeze in an obscure corner of the credit markets, eventually bleeds into this massive artificial intelligence build-out, how that collides with a completely paralyzed real estate market and ultimately forces central banks into a corner.
Right. And to understand the root of this fragility, we really have to start where the money is created, which is in a space called private credit.
Private credit. Okay, break that down for us.
So when a slightly riskier company needs cash, the traditional route is to issue junk bonds. And those are publicly traded. Every single day you can see the prices. You can see if investors are getting scared and demanding much higher interest rates to lend their money, what analysts call widening spreads.
That's completely transparent. You know exactly what's happening.
Exactly. It's a highly transparent system. But over the last 2 years, that landscape shifted dramatically.
Because, from what the source estimates, private credit expanded by 50 to 75% in just a few years, right? Basically stealing market share from that traditional, transparent junk bond market.
Yeah, it grew massively. It effectively became the marginal credit producer for the entire U.S. economy.
Hmm.
But the problem is, private credit is essentially a black hole of information.
How so?
Well, wealthy institutions are loaning money directly to companies with zero public visibility. There are no public quotes. The entire model is built on high fees, strict confidentiality, and honestly, an assumption that the good times will just keep rolling.
Which is perfectly fine when the money's flowing in, I guess.
Right. But the source notes, this massive credit impulse is now hitting a brick wall. The data shows that the inflows of new money into these funds aren't just slowing down. The actual rate at which they are slowing is dropping like a stone. It's a hard pause.
Wow. And late last year, there were a few notable bankruptcies, so investors are starting to get nervous. They're asking for their money back.
And that exposes the fundamental flaw of this whole asset class. They can't get their money back.
Wait, really? Why not?
Because these private credit funds are highly illiquid. The managers are legally allowed to throw up gates, literally blocking withdrawals. It's a trapped market. You only realize things are going south because the money stops moving entirely and the exits are padlocked.
Okay, let me see if I have the mechanics of this next part right, because when I read this in the source material, alarms went off in my head. Wall Street sees that this opaque, risky private credit is freezing up, so they bundle these loans together, wrap them in a third-party insurance guarantee, and then sell them off as premium investments to pension funds and life insurance companies.
Yep, that's exactly what's happening.
But pension funds have incredibly strict regulatory rules, right? Like, they are usually only allowed to buy highly rated, incredibly safe debt.
And that is the exact regulatory loophole Wall Street is exploiting. By purchasing an insurance policy on that bundle of opaque debt, they artificially boost the credit rating to AAA. Right. It tricks the regulatory framework, allowing a pension fund to buy assets they would normally never be permitted to touch.
I mean, that is pure financial alchemy. Taking risky, unpriced debt, wrapping it in a shiny new insurance rating, and dumping it into retirement accounts. It sounds exactly like the mechanics of the 2008 mortgage crisis. Are we just like putting a fresh coat of paint on a crumbling foundation here?
The source explicitly acknowledges that this setup smells awfully similar to the Great Financial Crisis. They are using these insurance wrappers to disguise assets that investors simply wouldn't buy if they could see the true stressed market prices.
So they're just shifting the risk.
Precisely. They are moving the ultimate risk away from the original lenders and dropping it squarely onto the balance sheets of high net worth individuals, insurance companies, and retirement endowments. When those underlying cash flows inevitably stop, ordinary retirement savings are the ones left holding the bag.
Ouch. So if these credit markets are starting to freeze up and hide their toxic assets, it makes me wonder how the massive multi-billion-dollar technology boom is actually being funded right now. I mean, where has all this aggressive corporate borrowing been going?
The vast majority of it has been funneled straight into the artificial intelligence infrastructure build-out.
The AI boom.
Yeah. Technology companies have issued a staggering $170 billion in corporate debt just this year.
Just this year, that's insane.
To put that in perspective, that is 4 times their annual average borrowing before the AI boom started. They are taking on massive leverage to hoard memory chips and construct sprawling data centers.
And you can really see the sheer weight of this in the stock market concentration. I mean, the S&P 500 isn't a broad reflection of 500 companies right now. 45% of the entire index is AI or AI adjacent.
It's totally skewed.
Yeah, and semiconductors alone, the companies physically making the chips, make up 19% of the S&P 500.
Which is incredibly dangerous. Having a single notoriously boom and bust industry hold almost a fifth of the entire U.S. stock market is historically unprecedented. It's so fragile. And we're already seeing the structural cracks globally.
Give me an example.
Take the Korean stock market index, for instance. 50% of their entire market cap is tied up in just 2 semiconductor stocks, including Samsung. That index recently suffered a massive 30% drawdown in a matter of weeks.
30%, that's not a minor correction.
No, that is a violent structural repricing of the industry's value. The credit markets are clearly starting to question the return on investment, the ROI of all this frantic AI spending.
Right, and the source lays out 3 specific headwinds hitting the AI industry simultaneously. The first one is pure commoditization. We are seeing new, highly capable AI models like DeepSeek and Kimi entering the market with rock-bottom pricing.
And commoditization is the ultimate destroyer of a debt-funded mode. Companies like OpenAI and Anthropic spent billions of borrowed dollars training their foundational models, obviously expecting to charge a massive premium for access.
Sure, they need to pay that debt back.
Exactly. But when a competitor releases an open source or heavily discounted model that performs just as well, it instantly turns that premium technology into a cheap commodity. The business model collapses, leaving all that early, debt-funded investment completely stranded.
Wow. And then there's the second headwind, enterprise pushback. The corporate clients who were supposed to be buying this software are, well, they're hitting the pause button.
Yeah, the source cites Alex Karp, the head of Palantir, noting that major enterprises are furious right now.
Why are they furious?
Because they're realizing the implementation costs are astronomical. The promised efficiencies just aren't materializing fast enough, and they are terrified that their own proprietary intellectual property is just being sucked up to train external models.
Which makes total sense. And that leads directly to the third headwind, which is just unyielding physics. There physically isn't enough electrical power on the grid to plug all of these planned data centers into. The infrastructure requirements have outpaced reality.
It's literally hitting a physical wall.
But let me push back on this on behalf of anyone listening who uses AI in their daily life. The technology is undeniably revolutionary. I mean, it is writing complex code in seconds. It is passing advanced medical board exams. If the technology is genuinely changing how we work, how can this massive investment be a bubble?
Well, it comes down to the critical difference between a great technology and a great investment. The source argues that bubbles are actually a necessary feature of capitalism. Bubbles built the transcontinental railroads in the 1800s.
And the telecom fiber optic network during the dot-com era, right?
Exactly. The technology in those cases was very real, and AI will absolutely deliver tremendous long-term productivity gains for society over the next decade.
But the visionary investors who funded the building of those railroads largely went completely bankrupt in the process.
Precisely the point. In the short term, this infrastructure build-out is a classic hype cycle fueled by cheap credit. The input costs are astronomical. Even the raw silicon chips are experiencing 30% inflation. And the corporate returns simply aren't there to service the debt.
So something has to give.
Right. The underlying valuations must undergo a severe reset. And when that price reset happens, the very credit markets that funded the boom will freeze up even further, creating a vicious cycle.
Okay, so we have the corporate sector struggling under the weight of AI debt and a frozen private credit market. Let's connect that corporate strain to the average person, because Main Street is fighting a totally different battle that feeds right back into this cycle. And the common denominator here is inflation, which is completely paralyzing the consumer and the housing market.
Yeah, the data on the American consumer is showing clear distress, particularly driven by recent oil price shocks and just the cumulative effect of rising costs everywhere.
What are the warning signs there?
We're seeing auto loan delinquencies and credit card defaults steadily ticking upward. Home foreclosures, while starting from a historically small base, are beginning to rise. The real economy is suffocating under the cost of living, even if the headline stock market figures mask the pain.
And that suffocation is most obvious in the real estate market, which makes up roughly 20% of the total U.S. economy. The source estimates that homes are currently 30% overvalued when you look at historical affordability metrics.
30% is huge.
Yeah, and the transaction volume has essentially died. 75% of real estate agents haven't made a single sale in an entire year.
It's completely paralyzed. And the metric that best illustrates this paralysis is the gap between the number of homes listed for sale and the number of homes actually closing. That gap has never been wider in recorded history.
So sellers are listing, but nobody's buying.
Exactly. New home sales are plummeting, leaving builders sitting on 9 months of unsold inventory. We have not seen inventory pile up at that pace since the immediate lead-up to the 2008 financial crisis.
It has created this fascinating, almost hostile generational standoff. You have the baby boomer generation holding roughly 60% of the existing homes currently up for sale, many of which are investment properties or second homes. And on the other side, you have the millennial generation, who are structurally priced out by a combination of high interest rates and inflated asking prices. It is a total buyer's strike.
And you also have to factor in the instability in the rental market.
Yeah.
Over the last few years, there was a massive 1970s-style overbuild in multifamily apartment housing.
Right. Driven by assumptions about population influxes and immigration.
Exactly. Now, to look purely at the economic math the source presents, without taking any political sides. If shifts lead to mass deportations or much tighter borders, that multifamily sector, which is already heavily oversupplied, will face an immediate severe crash in demand.
So in this standoff between the boomer holding the overpriced second house and the millennial waiting on the sidelines with no intent to buy, who actually blinks first? What forces the prices to finally come down?
It is entirely a question of market psychology. The source suggests that a broader macroeconomic shock is required to break the stalemate, specifically a severe correction in the NASDAQ as the AI bubble finally pops.
So the tech crash triggers the housing crash.
Yes. When older sellers suddenly watch their massive tech stock portfolios shrink by 20 or 30%, panic sets in. That is the psychological trigger that will force them to aggressively slash their home listing prices to lock in whatever real estate equity they have left.
I mean, that sounds incredibly painful for anyone holding those assets. But the source makes an interesting point that home prices clearing lower is actually vital for long-term economic health.
It is a necessary purge. When young people can finally afford to form new households, it drives significantly more beneficial economic activity. They buy appliances, they renovate, they start families.
The velocity of money increases.
Right. That velocity of money is much healthier for the real economy than a demographic of retirees simply hoarding empty, appreciating assets. The market requires this painful reset to function normally again.
Okay, so if the U.S. tech sector is stalling under its own weight and the U.S. housing market is completely paralyzed, we really need to look at how this demand destruction ripples globally, because an economic contraction of this size doesn't just stay confined to American borders.
No, not at all. The international picture is arguably more fragile, and it centers entirely on global liquidity.
Like what's happening in China.
Exactly. The source points out that China, historically the factory of the world and a massive driver of global growth, is currently in the acute phase of its own severe real estate crisis. They recently posted their weakest GDP growth since 2022.
And when the Chinese manufacturing engine slows down, the entire global supply chain shudders.
It does. And that global slowdown triggers a reflexive panic, causing international investors and corporations to scramble for the safety of U.S. dollars. This is why we're seeing the dollar currently breaking out to 52-week highs against other currencies.
But a rapidly strengthening U.S. dollar is notoriously toxic for global financial stability, right? It makes any debt that emerging markets owe in dollars incredibly expensive to pay back.
That's a huge issue. But more importantly, it threatens a massive, looming black swan event, the violent unwinding of the global carry trade.
Okay, let's break down exactly how that carry trade mechanism works because it sounds like a ticking time bomb.
It really is. Imagine taking out a massive loan in a currency, where the central bank keeps interest rates at virtually zero, like the Japanese yen. You take that incredibly cheap yen, convert it into dollars, and use it to buy high-yielding, aggressive assets in the U.S., like NVIDIA or Microsoft stock.
So it is essentially free leverage.
Exactly. Free leverage. But if the U.S. tech stocks start dropping in value or if the Japanese yen suddenly gets more expensive, the broker issues a margin call.
And the trader is forced to immediately sell their U.S. stocks at whatever price they can get just to pay back the yen loan.
Right. It creates a cascading avalanche of forced selling. The initial drop causes margin calls, which forces more selling, which causes further price drops. The source's overarching sequence is incredibly specific here. Oil and commodity-driven price shocks push the everyday cost of living too high.
Which causes massive demand destruction. People simply cancel vacations and stop buying discretionary goods. The economy grinds to a halt.
Exactly. So we transition from worrying about inflation, where things cost too much, straight into a severe deflation scare, where consumer demand evaporates and asset prices are plummeting way too fast.
That distinction is so important. The source is adamant about distinguishing the type of inflation we are experiencing. This isn't structural inflation driven by a massive demographic boom or runaway wage growth. It is a pure price shock.
Yes, and price shocks historically cure themselves through demand destruction. You can't afford the gas, so you stay home. When millions of households do that simultaneously, the economy contracts sharply, breeding deflation.
Yet the Federal Reserve is currently holding interest rates high to fight the ghost of that initial inflation spike. By keeping rates high while the underlying consumer economy is already contracting, the Fed is effectively squeezing those already frozen private credit markets we talked about earlier even harder.
They are actively starving a financial system that is desperate for liquidity. And that leads to the ultimate, unavoidable policy response.
Which is panic.
Complete panic. When the private credit gates lock, when the AI debt goes sour, and when the global carry trade aggressively unwinds, central banks will panic. To prevent a complete deflationary collapse of the sovereign bond and banking systems, the source predicts they will respond by initiating quantitative easing money printing on a scale that will make the COVID-era interventions look modest. They will have no other mathematical option.
Man. We have covered some incredibly heavy systemic weather forecasts here. If this macroeconomic storm is truly brewing, how is a normal person supposed to navigate it? What is the actual practical playbook for the listener right now?
The source divides his defensive strategy based on where you currently sit financially. If you are an asset-light consumer, meaning you don't own a home or have a massive stock portfolio to protect, your biggest and most vital asset is your biweekly paycheck.
So what's the advice?
His advice here is blunt and pragmatic. Make yourself utterly indispensable to your employer immediately.
Right? Do not just dial it in. Work the overtime. Take on the extra projects. Because when corporate margins get squeezed by this deflationary pressure, brutal reductions in force and layoffs are the very first lever management pulls. You want to be the person they absolutely cannot afford to lose.
Exactly. Now, if you are an asset-rich investor, the strategy shifts entirely to capital preservation. The primary goal is to raise cash. The source advises moving to a highly conservative 60-40 portfolio, or even taking 20 to 40% of your liquid assets and parking it in absolute safety like government money market funds or short-term T-bills.
And it is worth noting, he is not alone in this defensive posturing. If you look at the public filings of legendary investors like Warren Buffett and David Tepper, they are currently sitting on historic, massive piles of cash. They are retreating from the stock market and waiting for the dust to settle.
Yep.
But what exactly are they waiting for? That brings us to the source's most eye-catching prediction: gold hitting $10,000 an ounce.
Yeah, but the trajectory to that $10,000 target is not a straight lineup. It is highly nuanced. In fact, the source warns that in the initial stages of a global liquidity panic, gold might actually drop 20 to 40%.
Wait, drop? Why would it drop if it's a safe haven?
Because in a true global margin call, when the carry trade unwinds, investors and even sovereign nations are forced to sell whatever they can just to get their hands on U.S. dollars. He noted that countries like Turkey recently sold off massive tons of gold just to raise emergency short-term dollar liquidity.
So when panic sets in, everything gets liquidated.
Everything. But, and this is the crux of the strategy, the source strongly advises investors to buy that specific panic-driven dip, Because once the system fully cracks, the game theory of the central banks dictates the next decade.
Because they're trapped.
Exactly. When the crisis hits, they will have no choice but to use their balance sheets to swallow the toxic debt and save the system. They will intentionally debase their own currencies to inflate away the structural debt.
And a world where central banks are forced to print trillions of dollars just to keep the lights on is the exact macroeconomic environment where hard assets like gold skyrocket. He predicts that the massive post-crash monetary expansion will ignite a 5 to 7 year bull run, pushing gold to $10,000 an ounce by 2030.
It's a staggering prediction. He notes silver will also rise significantly, though cautions it is much more volatile because it is tied to industrial demand, which obviously plummets during a recession.
Ultimately, the entire playbook is about surviving the initial deflationary shock with your capital largely intact, so you are perfectly positioned to ride the massive engineered inflationary wave that central banks will be forced to create in the aftermath.
Yeah.
Well, let's tie this entire journey together. We started by looking at an economy that appears robust on the surface but is facing systemic rot underneath. The opaque, unregulated private credit market is quietly freezing up. That lack of easy money threatens the astronomically expensive AI infrastructure build-out, an industry already choking on commoditization and a lack of real corporate profitability. As those tech companies struggle, the pressure mounts on an American consumer who is already tapped out from inflation, resulting in a paralyzed, standoffish housing market. As demand destruction ripples globally, it causes a dollar shortage that forces the Federal Reserve into historic, unprecedented money printing, which ultimately acts as rocket fuel for gold.
It is a masterclass in macroeconomic synthesis. It demonstrates how interconnected these seemingly isolated markets truly are. The shadow credit markets, the tech sector's capital expenditures, your local housing market, and global central bank policy. They're all chained together in a very delicate balance.
It certainly changes how you interpret the daily financial headlines. I want to leave you with a final thought to mull over, something that builds on this entire sequence. The source reminded us that bubbles built the railroads, a massive infrastructure boom followed by a spectacular bust that ruined the early investors.
But those iron tracks stayed in the ground.
Exactly. They stayed in the ground and they powered the next century of economic dominance for whoever ended up owning them after the crash.
A phenomenal historical parallel for what we are seeing today.
So, if the AI infrastructure build-out is heading for a similar credit-driven crash due to basic commoditization and power constraints, who will be the robber barons of the 2030s? Who is sitting on massive, historic piles of cash right now, just waiting for the credit bubble to finally pop so they can swoop in and buy up all those distressed, half-built, state-of-the-art data centers for pennies on the dollar? Thank you for joining us on this deep dive. Keep looking past the headlines, keep questioning the consensus, and we will catch you next time.